Hello and welcome to episode 388 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, welcome back. How are you doing?
I'm good, Andy, but the same can't be said for you, unfortunately. Andy's been unwell this week, so he's come off his sick bed to do the podcast. So we seem to be passing the baton in terms of being sick, don't we, Andy? So it was the week before last, it was me, and then it was your turn.
Yeah, that's it. Well, I mean, we're just in sync, aren't we? We're like any good couple. We've synced illnesses together, and I just felt jealous, really. No, I'm much better now, so I'm glad to be back, and it's good to be doing the podcast again. Like, actually, I mean, I'm letting people behind the curtain a little bit here, but because I've been in and out of illness this week, I didn't know when my voice would be good enough to record, so I did actually record a bit of a segment to the podcast yesterday, so see if you can spot the difference, if you can hear a difference in my voice through the podcast.
It was probably a bit harsh of me, actually, Andy. I should have just said to you, do you know what, I'm going to do it all this week. And instead, I came up with a good idea that there was a piece that you could do on the podcast, which you admirably did. But yeah, maybe I should have helped you out with your voice. Before we move on to what's on the show, I just wanted to read out a podcast review that we received this week. And it was from Fiona D345. And the title was simply, "Please change the music," with 5 stars. Otherwise, all great, with an exclamation mark. So thank you, Fiona, for your review. Even if you don't like the music won't change because we paid somebody to make that, because we wanted to own the music and we had various different choices and we put it to a bit of a vote, and that was the one that we liked. And anyway, as I said, Fiona, listen to the podcast twice speed, then it sounds like a drum and bass track. So make sure you do that and then you will grow to love it as much as I do. Right. Yeah. What's on the show this week? There are 3 pieces this week. We're not doing any investing. I'm going to park that for a bit because there's some other bits I want to talk about. First thing, what to do if you can't pay your mortgage. Now, we're now in an environment where more and more people are becoming concerned about being able to afford their mortgage now or into next year. So the cost of living crisis is really starting to hit home. And of course, mortgage rates are going up. And there are lots of people who will be, in fact, there are millions of people that will likely be remortgaging onto much higher interest rates than they currently are on within the next 12 months. So they're going to be feeling that squeeze. So I wanted to let people know, what are the options? What should you do if you are worried about paying your mortgage in the future? I also want to talk about Stoozing. So Stoozing is something that's come to light. Actually, it came to light in our Facebook group. So don't forget, join our Facebook group if you are not a member. Some great content goes in there. Facebook.com/groups/money to the masses. And somebody asked, are people starting to stooze again? I'm going to explain what that is. But again, it's something that's come about because of the dynamics of the market that we are in. And that is a period where we're seeing higher bank account rates, but we also can still secure 0% credit card deals. And finally, Andy, you are doing a piece on...
It's a particular scam that's been doing the rounds of late, where even the most security conscious can be a victim. And there's a few simple things you can do to make sure that you won't become a victim of this scam. So listen in for that later in the show.
And it was a scam that caught a number of people, including journalists who write about money for a living. So it just shows you how sophisticated the scam is and how easy it is to become a victim. So I'll kick off now with the mortgage piece to save poor Andy's voice. Now, as I mentioned in the intro, we are getting into a world where more and more people are being concerned about their mortgage. And it's not just a low income problem. Because of the low interest rates that we've had over the last decade, basically since the financial crisis, it means as a nation that we've been taking on much higher mortgages, and now rates are going up. We're starting to feel that pain, because as that stat I've repeated a couple of times, for every 1% that a mortgage rate goes up on a 25-year deal, for every £100,000 of mortgage that you have, you're looking at approximately an extra £50 a month on your mortgage repayments. So if you have a large mortgage, that will start to really impact you as well. It's not just a dynamic of having a low income. Now, we are already nearing the point where the squeeze on our incomes, there's a percentage of money that we take home that is being paid out on mortgage. That's getting to the levels that we last saw back in the early 1990s. So when mortgage rates were at 12%, when people had much smaller mortgages. So if you are worried about mortgages, or you are thinking that you want to just have a bit of a checklist of what to do in the future if we get to a stage where you are struggling, it's nothing to be ashamed of. People lose jobs, circumstances change. Now, the first thing I would say is that if you are worried about paying your mortgage, then do avoid missing payments without speaking to your lender first. So that's the big thing to focus on. Don't just bury your head in the sand and avoid paying your mortgage repayments, because the lender will catch up with you very quickly and be in touch to find out what's happening. If you do that, it starts to limit your options in the future, because at some point you will want to apply for credit again, and obviously if you miss mortgage payments, it will hurt your credit report and ultimately any credit score that you get when you apply for credit in the future. So the first thing you really need to do is speak to your lender. Now, I'm going to come back to an overarching bit of advice at the end, but this is general sequence of events that is widely accepted out there. So you should speak to your lender, and that is because if you speak to your lender, you could come to an arrangement with them to ease the burden of your mortgage payments. So for example, the lender should try and work with you, because repossession is really a last resort. That's because of the rules out there. In fact, lenders can't seek repossession unless they've made attempts to reach a reasonable agreement during this period where you're struggling. So they are interested in helping you to be able to pay your mortgage. So if you speak to them, they may be able to extend your mortgage term, so that can therefore reduce your monthly remortgage payments. They may accept smaller payments in the short term instead, or they could potentially agree to switch you to an interest-only mortgage. The other thing that you could potentially agree with them is a mortgage holiday. And so that's where you might have a period, say between a month and 12 months typically, where you agree that you won't be paying your mortgage payments. And what will happen is those payments that you've been allowed to miss, they don't disappear, they get added back onto your debt. And when you come back from the mortgage holiday, then your payments will go up. So you will be paying more a month as a result after the mortgage holiday than you were before it. Now, usually you can't get a mortgage holiday unless you've had a mortgage with your lender for 6 to 12 months. You need to check your T's and C's. So I would say to anybody listening to this podcast, no matter how well you think you're coping with the cost of living crisis, it's worth digging out your paperwork and seeing what T's and C's there are around mortgage holidays and whether you can take one and how long for, because you never know if you might need to call upon it. There might also be caveats in there that state the maximum loan to value that is allowed for you to take a mortgage holiday. So again, that's something to check. Now, obviously, you'll be having conversations with your lender. They may come up with this as a potential solution. Then you need to make sure you can afford the payments after your holiday, because like I said, they will go up. And just to give people an idea, if you had an interest rate of 4.5%, so that could be, say, this time next year, because rates are already at that level, and you had a 25-year mortgage, it was for £200,000, then broadly speaking, you'd be paying £1,110 a month as a mortgage. If you took a 3-month mortgage holiday, then the impact would be that when you came back after those 3 months, your mortgage payments would have gone up to £1,128.60. So it's not a huge amount in that example, but you only took a 3-month holiday, so that's £18 a month. But of course, because of the interest that's being added and you haven't repaid part of your debt during that 3-month break, in the long run, when you get to the end of your mortgage term, the actual additional cost of that holiday would have been £2,000 to you. So that's almost the charge, if you think about it in a roundabout way, that you've had to pay the penalty for taking that holiday. It's cost you £2,000 more. And that's because if you think about it, at the end of the 3-month period, you've got a bigger outstanding mortgage than you should have had. And of course, the interest is applied to that. So if you are going to even explore that option with a lender, make sure you also ask them how it will be shown on your credit report. Because taking a mortgage holiday, in theory, if you look at what experience says, that it will likely show on your credit report and therefore ultimately impact any credit score going forward. And the reason you want to know how it's going to be shown on your credit report, because if you get your finances back in order and you overcome this difficult period, then you will want to know how it could impact your future borrowing. But of course, if you are putting out fires, then you are going to be less worried about that future impact. I get that, but bear that in mind. It's just so people realize that you don't do these things unless you really need to. Now, the other thing to think about is there are things called mortgage payment protection insurance, which some people have been sold in the past, which is effectively a policy that can help pay your mortgage payments if you're no longer receiving a secure income. So it could be that you're sick. It could be on some of them that you lose your job. So if you have a policy like that, then you may be able to claim upon it, because that's what it's there for. And the thing about those which is useful is that it pays the full payment. So that means the capital and interest. And the reason I specify that, I'll come on to, there's a government scheme that exists for those who are in real trouble that doesn't reduce your outstanding mortgage. It only tackles the interest. So there may be people who are thinking, well, maybe I should start looking into getting one of those mortgage payment protection insurance policies, so MPPI for short. The one thing I would say to that, if your job is under threat in any way, or you already have a health issue, so you're already in poor health, then it's unlikely you will be able to claim on the policy anyway. So you can't take these things out after the horse has bolted. So the one thing to point out about mortgage payment protection insurance is only a short-term solution. It doesn't pay out indefinitely. And of course, there are things like income protection policies we've talked about in the past that people can take out that will place a portion of their income if they are unwell. So it won't necessarily be linked to if you lose your job, but it may be if you are unwell. So people may be worried about that. They may have some money spare and they think about trying to protect their mortgage in the future because their savings wouldn't be able to do it in the future, whereas their savings now may be sufficient to have paid their existing mortgage for a period of time. So some people might be looking at that, or whether employers can offer such a benefit. Now, of course, I'm talking about all of this assuming that you're not going to downsize and you can't remortgage onto a cheaper deal. That's the world we're in. When they're remortgaging, they're getting more expensive deals. So that's the assumption here. Now, one other thing I'll just throw into that is that do check the benefits you are entitled to as well. So go to entitled2.co.uk, which is the official calculator where you put in your details and it will tell you any benefits that you may be entitled to. So what I want people to also remember is that you may have this vision of people who claim benefits. Get that out of your mind, because actually a large proportion of people who claim benefits aren't just sitting around doing nothing. They actually work for a living. Now, there's a really good editorial piece by one of the editors of a national newspaper, and he wrote a piece about claiming benefits and that he does, and it's because he has a child with a disability, so his family need help with the cost towards that, because it's obviously very expensive raising a family if you have a child with a disability. And so he was writing about the benefits that he claimed and how he was worried about what the government might do to benefits in terms of cutting them in order to balance the books. So don't be one of these people who doesn't look at what benefits they might be entitled to. And the reason why it's also important, because there's a next step in all of this, that are government schemes that you can take advantage of, and it depends where you live. So there is an overarching scheme called the Support for Mortgage Interest, which is shortened to SMI, which is available to homeowners that get certain income-related benefits. Now, those benefits can be income support, income-based job seekers allowance, income-related employment and support allowance, universal credit, or pension credit. So this scheme works by effectively giving you a loan to pay towards the interest element of your mortgage repayments. And those payments are made directly to the lender. We'll put a link in the show notes to an article on the Money to Masses website which explains how the scheme works. But what it does, it doesn't pay back any of the capital that you've borrowed or any mortgage arrears or any related insurance premiums. It just contributes towards the interest element of your repayments. Now, the interest rate it uses is 2.09%. So the actual rate that you pay on your mortgage is irrelevant. So if you pay a lower rate, then it may technically be able to repay some capital. But obviously, if you pay a much higher rate, which is probably what most people will do, then you may find yourself with mortgage arrears anyway. Now, you can claim help with interest on loans up to £200,000 or £100,000 if you're receiving pension credit. So that's even the case if your mortgage is higher than those limits that I've mentioned. That's the maximum help you can get. Now, there are waiting periods as well. So if you're over 60 and you're claiming pension credit, you can get help immediately. But for others who qualify via the other benefits, the payment starts 39 weeks after you started claiming any of those benefits. So at the moment, for people claiming job seekers allowance, the support for mortgage interest will only be paid for up to 2 years. And there is no time limit if you're receiving income support, pension credit, universal credit, or income related employment and support allowance. Now, we'll put a link, as I said, to the show notes so you can read more. Now, you do have to pay this back. It is a loan. So you pay it back along with the interest that you've accrued when you sell your home or transfer ownership. Now, the rate of interest on the loan is 1.4%. And when you come to sell your home, then the loan is paid off with any money that's left over after you've repaid the mortgage or any other home improvement loans or loans that are secured against the home. If there are insufficient funds to repay the SMI loan, then it technically can be written off. Now, when you apply for benefits, because this is based upon benefits, then you will be told, or you should be told, whether you'll be eligible for the support for mortgage interest scheme. Just to quickly touch on other schemes that exist. In Wales, there is another scheme. So some local authorities and housing associations operate the mortgage rescue scheme. So that is aimed to help avoid repossession, and it's not done via private sale and rent back mechanism. So it works in two ways. It can be a shared equity loan, or you can get a mortgage to rent scheme where local authorities buy and rent back the house to you. And in Scotland, there is a homeowner support fund, which again, there's two parts. It can be the mortgage to rent, so a social landlord buys and rents a home back to you, or you can have a mortgage shared equity scheme where the Scottish government buys up to 30% stake in your home, which therefore reduces your mortgage and therefore your repayments, and you can continue to live there. Now, again, there'll be a link in the show notes for more details on these schemes. Now, one of the overarching things you should do if you are worried about debt at all is get free debt help. Now, there are charities out there that can help you, so you get in touch with the likes of Shelter, National Deadline, or Step Change. And be careful when you're Googling any of those things that you get the correct entity. And we'll put a link in the show notes and on the website for this particular episode to our article on how to get free debt advice. Because the reason it's important to speak to these people is they can give you options or tell you what your options are when it comes to dealing with your mortgage debt or any debt that you have. And the other thing they can do is they can help you when you come to speak to your lender. So you're having worries about your mortgage, they can help you through that process, tell you the questions you should ask or the requests that you should make. So it's important, despite the steps I've mentioned, overarching, if you've got any issues, speak to one of those charities and they will give you advice for your circumstances on what you should be doing. And the other thing is that it can be good or look good if we get to that stage, unfortunately, where your lender will go to court in an attempt to repossess your home. It will look good if you've been in touch with one of these charities to try and resolve your debt issue. And therefore, it may mean the court won't rule in favour of repossession. Now, the other thing that's important about if you talk to debt help charities is that there are rules now in place that you can get a 2-month breathing space from interest in enforcement actions via something called a breathing space. And it can only be applied for by a professional debt advisor or your local council. So that could give people some time to get on top of their finances, because during this breathing space, you won't be charged additional interest or fees of any kind. And it only covers mortgage arrears. Given that we're talking about mortgages, it covers mortgage arrears, not the fact that you won't pay your mortgage. It's the arrears. So you already have to have some arrears. That's what that would help you for. If you have a mental health crisis, then your breathing space can last longer as it covers the period through which you are being treated. So speak to a debt advisor and they will tell you much more about this kind of thing. So there we go, Andy. I've covered a hell of a lot there. We will, like I say, put links in the show notes. But the message you need to take away is don't bury your head in the sand. Be proactive if you are starting to worry about your mortgage. And it's one of the reasons why this year I've been talking about being proactive ahead of a scenario where we're going to pay much higher mortgage rates. So if you do get into difficulty, still continue to be proactive and make sure you speak to debt charities and your lender.
Okay then, so let's move on to stoozing. What is it? Is it a good idea? Damien, you're going to just give a bit of a rundown because it's actually gained a bit of traction in the press recently.
Yeah, so stoozing is a technique where you make money by earning interest on cash credit cards that lend at 0%. So to run through a very simple process how this could work, if you've got a good credit rating, you might decide, for example, to take out a 0% spending credit card. So 0% purchase credit card, which means everything you buy for a period of time that's agreed, obviously, depends on the term of the deal, that everything you buy doesn't attract interest. Now, if you use it for all your everyday spending and you pay the minimum repayment that you're required to, then the money that you're not spending from your current account that you would normally do on your everyday spending, you use that to build up savings at a higher rate as possible. So you go and look for the best savings rates that are out there. Then when the 0% deal comes to an end on the credit card, then you would use the money that you've saved up, clear the balance that's on that credit card, and then you would have obviously made money. The interest is your profit. That is the simple process. Now, technically, there is a next step that you can do where you do a balance transfer at the end of your 0% purchase deal, and you transfer the debt you've accrued on the credit card onto a 0% balance transfer card, and then the money you've got in savings can earn interest for even longer. So in theory, you increase your profit again. Now, people might be thinking, yeah, when you move money onto a balance transfer card, there was normally a fee involved. Yes, that fee is often around about 2.5%, but there are 0% balance transfer cards that exist out there. The issue with some of those, if you apply for them, you won't necessarily get the 0% fee version. It is possible you can apply, and once they make the assessment, the credit card company actually charges you a small fee for moving the money across. Now, one obvious issue is if we got to the end and somebody had gone down that route and decided to extend the whole game by taking out a balance transfer card at the end to extend the period of time they could keep the money in their savings account effectively, then if you locked your money away in a savings account that gave you a higher interest and then you weren't accepted on the balance transfer card for some reason, then you end up being in a situation where you're probably going to have to try and get your money back from that savings account to clear the debt that you had on the credit card, which may mean you lose interest rate. You could get yourself into a bit of a sticky situation. Now, obviously, going back to the straightforward process where you use the 0% purchase credit card and you go through and the money that you are effectively saving in your current account, you can put that in savings accounts elsewhere to get a better rate. And it's because savings rates have been rocketing that stoozing is starting to become talked about again. Like I said, it was talked about in our Facebook group this week. You can get 2.75% on an easy access current account at the moment, which if you go back just 6 months ago was unthinkable. You can get more than 5% on a high interest current account. So those are the current accounts that you get that will have a attractive interest rate that's applied to a portion of the balance, something like £1,500, for example. Then beyond that amount, you don't get much interest on any money you've got in that particular current account. You can obviously lock your money away in fixed term savings bonds, but you're then going to start getting to a period where you might have the money stuck in one of those savings accounts and you need to clear the balance on the credit card. So that is a risky strategy, but you can again fix a 1 year fixed savings bond. You can get over 4% at the moment, and the direction of travel for rates seems to be higher at the moment, at least. So stoozing seems to be coming back in fashion. And who is it I say good for, and I'm doing that inverted comma thing that doesn't really work when you're doing audio mediums like podcasts, but who is it good for? Well, people who have good credit scores and no debts. Because if you've got debt, the only reason you should be taking out another credit card is probably to reduce the interest rate that you're paying on all of your debt. So you might do a 0% balance transfer credit card, for example. So you need to be a disciplined person and really attentive to what's going on with your spending, the cards, the dates that you have to do certain things. And to be honest with you, I think for most people, you'd probably be better off just using a cashback credit card if you want to make money out of credit. So you could have a cashback credit card that pays you money as you spend. You then at the end of the month clear the balance of that credit card with the money you've got in your current account that you've not used to do your day-to-day spending. That is probably a far better route for most people. And the issue, the cons of the whole thing is that taking out lots of credit and credit cards in a short space of time and having high balances, because don't forget, you're going to rack up a pretty high balance to make this worth your while on the credit card that you're using to do this stoozing. That can all be negative for your credit report and your credit scoring that you have when you come to borrow money in the future. I would almost certainly say if you're going to be trying to get a mortgage at some point, then this isn't really a good idea, because it depends how the lender looks at what you've been doing when they look at your credit report, because they don't know that you're stoozing. That's the thing. They won't link the things up. So that is down to the lender. So that's why for a lot of people, I still think just having a simple cashback credit card is the best idea. Because if you mess this up, it can be quite costly. Now, if you're wanting to stooze, or you're wanting a cashback credit card, or you're just wondering what the best 0% balance transfer credit card or the best 0% purchase credit cards are, then we provide a roundup on the Money to the Masses website. You can find it by searching in the search bar at the top of the website, put in best credit cards, and of course we'll put a link in the show notes of this episode. Right, so Andy, moving on to your piece.
Okay, so the piece that I wanted to cover on the podcast this week covers a scam that has happened to a number of victims in the London area, and it's becoming more widespread. And so I really wanted to alert you, the listeners, of what this scam is and how you can avoid becoming a victim. Now, it's a particularly sophisticated scam, and even the most security conscious of us could potentially become a victim. And so let's explain what happened then. There have been a number of thefts that have taken place, specifically from gyms where people have had their possessions stolen from lockers. Now, this scam isn't exclusive to gyms. It's just almost the perfect opportunist way that fraudsters can get hold of all the details that they need in order to carry out this scam. So what is happening is people are having their lockers broken into and having their possessions taken. And in a lot of cases, that will involve not only wallets, which contain cards and card details, but also mobile phones. And it's those two crucial pieces of information that are being used in combination in order to carry out this crime. So let's rewind then. What's happened? So there's a couple of stories that have hit the national press recently where people have gone to the gym, they've put their possessions into a locker and stored them away, and they think no more of it. Everything's nice and safe. They've gone ahead with their normal workout, and then they've come back to find that their locker's been broken into and their possessions have been stolen. But worse than that, when they've gone and backtracked and gone to cancel their card details, they found that their current accounts have been wiped and their life savings have disappeared. Now, how can this possibly happen? Well, it's quite scary stuff, and actually it's relatively simple how this fraud has taken place. So what fraudsters are able to do in some cases, if they have access to a number of credit cards or debit cards, but also crucially a mobile phone as well, they can combine those two to potentially defraud the victim. Now, even if you're the most security conscious and you have biometrics in place whereby your phone will only unlock with your thumbprint or through retina scanning, and even if you use two-factor authentication on all of your apps and all of your devices, this could still be an issue. And the reason for that is there are a couple of security flaws within the system that have been highlighted, and it's worth mentioning on the podcast. So, having researched and read the story, and lots of security experts have been offering their advice on what they think has probably happened and how to prevent this from happening in the future. They reckon that there's one of two things that has happened in this situation. One issue is that security features that exist in certain banking apps like Biometrics, which is thumbprints and retina scanning, can effectively be overridden by simply removing the SIM card from the device and putting it in a new device. An analogy is being used that it's like an open window to a thief. So how do you stop that from happening? Well, quite simply, you can go into your SIM card settings and request that a PIN is entered in order for that SIM card to work on any new device. Doing that one simple step could ensure that you don't fall foul of that, what looks to be a pretty obvious security flaw. And secondly, and what is probably the most likely way that these thieves, without any biometrics or passwords or PIN codes, were able to override the whole system and clear your bank accounts, is because of the way that security passcodes are requested and displayed on a device. So let me just explain how that works. You've probably done it many times before, perhaps where you've gone to purchase something on a website or you've gone to register a new card on a new app, and you're told that an SMS, a text message, will be sent to the phone that is registered with that product or service with a security code. And once they can marry those two codes up and you type that in, then the system allows that to go through. true. One problem, however, is that many phones will display that SMS as a preview, even if the device is locked at the time. And so you can imagine, therefore, in the wrong hands, a thief with a number of debit and credit cards, and also the device that is linked to many of those cards, which let's assume does have this security feature where the security code flashes up on the screen as a preview. That is a potential disaster waiting to happen. So there's a couple of things you can do to make sure that you don't become a victim in this way. I mean, firstly, and most importantly, it's not always possible, but it makes sense if you can. When you're storing possessions, if you can actually store your wallet and your phone in different locations. So for example, if you're going to the gym and you don't need to take your phone or wallet, leave one of them at home. But if you do need to take them, perhaps store them in different lockers in different locations. And that way the thief hasn't got access to both things. Another thing that you can do, which is really, really simple, is go into your phone settings and disable the feature that allows that security code to be previewed from a lock screen. And so if that's you and you've got an iPhone, simply go to your settings, go to notifications, messages, show previews, and then choose never or off to disable those message previews. And if you're on Android, go to your phone's settings, tap apps and notifications, and then under the lock screen tab, choose don't show notifications, and that should disable that feature. So there's a couple of quick tips on how not to become a victim of that particular fraud. And I must say it's one that I hadn't personally thought about, and having checked the notification settings on my phone, I was able to see that mine also show up on the lock screen as well. And I think it's that way for convenience and everything else, but actually security wise, it's not the best idea. So one thing you should all do now, go and check your settings, go and disable that. Also set yourself a PIN code for your SIM card so that the biometrics security features can't be overridden. And so that's it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. You can get in touch with us in all the other ways. And don't forget to check out our YouTube channel, the community group. It's facebook.com/groups/money to the masses.
And of course, don't forget that I am doing a live event on the 26th of October in central London. I'm on a panel discussion. So again, we'll put a link in the show notes to where you can actually find out details and register. I'm always conscious, I keep saying, putting things in the show notes. And I just think of poor old Andy when he does the edit for this. He has to go and find all these links. So apologies, Andy. I said it a hell of a lot in this episode. I think there must be about a dozen of them, but when needs must. Anyway, that is it for this week, Andy. Until next time.
Until next time.